Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
And welcome to our final deep dive of 2025. You shared an incredible stack of sources with us, CNBC, Yahoo Finance, some analyst notes, and our mission today is really to cut through all that noise.
Exactly. We're going to synthesize the most important nuggets so you can hit 2026 well-informed.
And if 2025 had one theme, it really was volatility, wasn't it?
Oh, absolutely. And the pressure that volatility put on, well, everyone, policymakers, investors, you name it.
So today we're tackling three massive intertwined themes that really define the year.
Right. First, the agonizing decisions coming out of divided central banks. Then, the raging valuation debate around the AI boom.
And finally, a big one, the emerging and I think critical geopolitical flashpoint involving industrial metals.
It was the year where, as one hedge fund manager put it, you really just needed to be brave to stay in the market.
That's a perfect way to describe it. So we'll start with the macro picture, looking at the Fed's balancing act.
Then we'll jump into that whole tech trade, the AI euphoria.
And wrap up with the physical commodities, the actual metal that underpins that entire tech revolution.
Okay, let's unpack this, starting with the Federal Reserve. I was looking at the minutes and Treasury data reported by, I think, both CNBC and Yahoo Finance.
Yeah, and for investors, the biggest surprise from those December 9th and 10th FOMC minutes, it wasn't the cut itself.
No, the 25 basis points was pretty much priced in. It was the division.
That's the crucial detail, isn't it? The sheer level of dissent. That final vote to cut rates came in at 9-3.
9-3. Now, in Fed terms, that's huge.
It's enormous. 3 dissents is practically a rebellion. It's the most dissent we've seen in a policy decision since, 2019? It reflects a really deep philosophical split.
And the split wasn't about whether the economy is good or bad right now. It was all about what happens next.
Exactly. The majority felt that, further cuts would probably be appropriate if inflation kept falling as they expect.
But that minority, the 3 dissenters, they were saying something very different.
They were. They basically suggested that after this one cut, they needed to hold the target range steady for some time. They want to anchor expectations.
That minority view is really what you should be watching because it signals that even if the Fed does cut more, they might be way less aggressive than the market thinks.
Well, this whole debate is happening because the economic environment is so contradictory. On one hand, officials noted downside risks to employment.
So risks to the job market.
Right. But at the same time, they see these stubborn upside risks to inflation.
And you see that strength in the GDP numbers, don't you? Growth was surprisingly strong, soaring at a 4.3% annualized pace in Q3.
Which is way ahead of estimates. That signals incredible underlying strength, and it makes the argument for holding rates higher for longer really compelling.
But there's a catch, a big one.
There is. And it's that officials also had to caution that the quality of the economic data they're getting is still, a bit fuzzy.
It's being affected by the delays from the government shutdown earlier in the year.
That's a really important point for you to remember. It means the Fed isn't working with a perfect, high-resolution picture of the economy right now.
They're flying with a dimmer, maybe older snapshot of what's happening, which makes fine-tuning policy almost impossible. They could be over or undershooting based on imperfect information.
Absolutely. And it wasn't just about rates. The Fed also resumed its balance sheet expansion, but in a very specific way.
Yeah.
They voted to start buying $40 billion a month in short-term Treasury bills.
Okay, I want to clarify this for everyone listening. This is not quantitative easing or QE like we saw after 2008.
Great distinction to make.
That was buying long-term bonds to push down long-term rates. So why are they buying short-term bills now?
It's a technical move, really. It's about market mechanics. The system uses these short-term T-bills as collateral for everyday transactions.
And since they shrank their balance sheet, those markets were getting tight.
Exactly. Short-term funding markets were getting stressed, liquidity was tightening up. So by buying $40 billion in bills, the Fed is just easing that specific squeeze. It's a signal that even with high rates, parts of the market are still a bit brittle.
So investors are looking at a divided Fed, strong growth, but also signs of market brittleness.
And that anxiety showed up in the bond market yesterday. The 10-year Treasury yield dipped just a bit to around 4.1112%.
As everyone waits for the final piece of 2025 data, jobless claims, we are right down to the wire.
All right, so let's pivot from macro policy to, market euphoria.
We're diving into the tech sector and the perpetually contradictory world of Michael Burry, looking at some reporting from CNBC and Yahoo Finance on this whole AI valuation debate.
Burry, the famous big short investor, he weighed in again this week. He's still maintaining his view that Tesla is, and I quote, ridiculously overvalued.
But what's fascinating is how he's hedging. He actually went on social media to publicly deny that he was currently shorting the stock.
It's that classic dilemma, right? You can see a massive bubble, but you also know that fighting it can be incredibly painful and costly.
And the valuation disconnect for Tesla is just baffling. This stock rallied, what, nearly 14% this year?
Right, but if you look at the actual business, the cars, it's a totally different story.
Completely. Their own Q4 delivery estimates show a 15% drop year over year. That puts them on track for a second straight year of falling sales.
Sales are shrinking, but the stock is soaring.
And that's where the AI boom thesis just takes over. I mean, analysts at places like Deutsche Bank and Wedbush are basically saying the car fundamentals don't even matter anymore.
It's all a bet on the future. It's a bet on mobility, robotics, and AI.
The robotaxi hype, full self-driving, the cybercab network, all of it.
Which is how you end up with a forward PE ratio over 200. That's not an automaker multiple. That's pure growth speculation.
The market is pricing in the singularity, not this quarter's car sales.
Exactly. And that speculation needs real physical infrastructure.
Yeah.
And this is where the AI spending spree is just accelerating. Elon Musk's other company, xAI, is aggressively expanding.
They're buying a third building in Memphis for their Colossus supercomputer cluster.
And the target is just staggering.
Nearly
2 gigawatts of compute power.
Wait, 2 gigawatts? That is enough to power a small city. So the AI race isn't about code and chips anymore. It's about securing massive amounts of energy.
It is a power grid race, full stop. We saw this in the news that Goldman Sachs is co-leading the financing for a huge project down in Texas, the South Dallas One project.
And they're not just building a data center, right?
No, they are building dedicated natural gas-fired power plants, specifically for these new AI data centers. Each site is planned for 1.5 gigawatts of capacity.
So the real constraint on AI growth isn't software engineers, it's literally access to power.
Which is where the bubble warning signs get really loud. You have this euphoria, this massive spending, and then you have history kind of tapping you on the shoulder.
And the sources highlighted two of these signals. The first is the Buffett indicator.
Right, which is the total stock market cap divided by the U.S. GDP.
Yeah.
And fueled by this AI surge, that metric is now at an all-time high of 221.4%.
Historically, when it gets above 200, that suggests the market is deeply overvalued and a pullback is overdue.
And for a little touch of irony, CNBC actually went to the source. They asked the Unitree G1 humanoid robot, KOID, about the AI bubble.
What did it say?
It gave a perfectly neutral, non-committal outlook. It just said that whether this is a transformative wave or a bubble is, quote, something only time will tell.
So even the AI is hedging its bets on its own valuation? That's incredible.
The robots might be hedging, but there's one area where the risks are very real. The physical resources.
Let's move from the virtual world of compute to the raw materials fueling this boom. Again, looking at reports from Yahoo Finance and CNBC.
2025 was just a historic year for precious metals. Gold and silver are on pace for their largest annual gain since 1979.
Gold futures were near, what, $4,362 an ounce? Mostly driven by all that macro uncertainty we talked about?
The drivers for gold were pretty clear. A weakening U.S. dollar, down nearly 10% in 2025, and those 3 Fed rate cuts.
Plus, central banks have been buying gold like crazy, up 68% year to date. That's a huge floor under the price.
But the real urgency, the new story, is in industrial demand. This is why Josh Fair, the CEO of Scottsdale Mint, he coined the term metals war.
A metals war.
Yeah, the global AI race, the push for electrification, onshoring manufacturing, it's all creating this frenetic, competitive demand for critical minerals. Platinum and copper are near record highs.
And silver is at the absolute center of this. The U.S. recently added both silver and copper to its critical minerals list.
And for good reason. The Silver Institute says about 60% of the world's silver supply is used in industrial applications.
We're talking solar panels, EV batteries, and crucially, high-performance parts for data centers and microchips.
This is where geopolitics crashes into the commodity market. China, which is the third largest silver mining country, is about to impose strict new restrictions on silver exports.
And that starts Thursday, January 1st. What does that move mean strategically?
It means Beijing is putting silver on the same regulatory footing as rare earths.
Which China has historically used as leverage in trade disputes.
Exactly. It's seen as China tightening its control on materials that are vital to advanced tech and defense sectors around the world. They're basically weaponizing their supply chain.
And we saw an immediate market reaction. Elon Musk tweeted, "This is not good. Silver is needed in many industrial processes.
But the concrete examples are even more telling. Look at what Canadian supplier Kuya Silver reported.
They said 2 Chinese companies and 1 Indian buyer recently came to them offering huge premiums.
Huge. We're talking up to $10 above the market price just for physical silver for immediate delivery. That shows the supply anxiety is acute. Buyers are scrambling before these Chinese restrictions kick in.
This isn't just a commodity headline. It's a massive supply chain risk for the entire tech sector.
Okay, so shifting our focus to global returns, 2025 was, for the most part, a spectacular year. The MSCI All-Country World Index gained over 21%.
That's a fantastic headline number. But that number hides some massive differences around the world based on data from CNBC and Morningstar.
Let's look at the extremes. The standout winner globally was Colombia, which surged over 91%.
91%. That jump was amplified by its index being so heavy in banking, which benefited from high commodity prices and, hopes for a more market-friendly government.
And South Korea was another huge winner, up around 80%.
Their market is all about chip and tech giants like Samsung and SK Hynix, which had a massive recovery thanks to higher memory chip prices.
Which were fueled by, you guessed it, the AI spending spree we just discussed.
On the other end of the spectrum, the big loser was Denmark, down 13% for the year.
And that was almost entirely because of one company, Novo Nordisk. The shares dropped a staggering 48%, and the market there is so concentrated, it just pulled the whole index down.
It really highlights the risk of concentration. It can cut both ways.
And focusing on Europe, the banking sector had a truly incredible year. The STOXX Europe 600 Banks Index surged nearly 60%.
That's its best annual showing since 1997. They benefited immensely from higher interest rates.
Which now leads to the big question for 2026. What do these super profitable European banks do with all their significant excess capital?
Analysts think they're going to pivot hard to M&A.
Exactly. They expect a lot of consolidation, especially in Italy and the UK, as banks look to diversify their revenue and find new growth.
Meanwhile, the media sector had one of the biggest corporate dramas of the year. Warner Bros. Discovery is expected to reject that revised, $108.4 billion hostile bid from Paramount Skydance?
Yeah, even with that personal guarantee from Larry Ellison, the deal is just seen as too complex.
So Warner Bros. Is expected to pursue Netflix's lower $82.7 billion offer instead, because the financing structure is just much clearer.
And the political weight here is huge. President Trump has already signaled he plans to weigh in on this acquisition, which just shows you the significance of who controls the media landscape.
Finally, let's close with an industry that's all about celebration but is now tangled in some really serious controversy. Champagne.
Yeah, despite surging New Year sales, the industry is clouded by some really serious ethical issues.
It's a supply chain risk you just wouldn't expect. Reports came out this year about the widespread exploitation of the 120,000 seasonal migrant grape pickers.
It includes the horrific 2023 Harvest of Shame, where at least 4 pickers died during a heat wave because of just completely substandard working and housing conditions.
It's awful. Following some convictions for human trafficking, the governing body, Comité Champagne, has adopted a zero-tolerance approach.
And the big producers, like Moët and Chandon, are responding. They're investing heavily in new, safer worker accommodations.
And to top it all off, you have those U.S. import tariffs on EU goods, which are causing champagne shipments to the U.S. to slump. So they're dealing with an ethical crisis and an economic headwind at the same time.
It's a stark reminder that every single product, no matter how luxurious, is subject to intense supply chain scrutiny and geopolitical pressure.
So what does this all mean for you as you head into the new year? We've covered a divided Fed, AI euphoria that's defying gravity, and a full-blown metals war.
The key takeaway is just realizing how connected all of these global forces are. A small tweak in Fed policy sends the dollar moving, which affects gold prices.
Tariffs in Europe affect bank profits.
And, most critically, geopolitical tension over silver in China directly impacts tech companies trying to build AI infrastructure in Dallas. Understanding these feedback loops is everything for navigating 2026.
Absolutely. Now, for one final provocative thought to mull over, we learned today that U.S. tariff rates are ending 2025 north of 15%, the highest average in 80 years.
And one investor compared this year's volatility to needing to be brave.
So you have to ask yourself, which of these headwinds, the rising tariffs, China's export controls on metals, or the Fed's uncertain rate path, which one will prove to be the single most volatile element in the first quarter of 2026?
That is something to think about over the holidays.
For the deep dive, we'll see you all Friday morning with new headlines from major financial magazines.